Good afternoon, everyone, and I'm delighted to have this opportunity to moderate such a distinguished panel. I think we have a good opportunity to get around the topic of climate change and central banks this afternoon. And with me today, Nathalie Aufauvre, who is in the NGFS SteerCo and also General Director of Financial Stability and Operations at the Banque de France. We have Timo Tyrväinen, I'm working on my Finnish pronunciation, who's Chief Economist at the Climate Leadership Coalition, and also Thomas Mélonio, who's Executive Director of Innovation Strategy and Research at Agence Française de Développement. What really strikes me when we look at the topics we've been discussing this morning, be it the pandemic, be it the war in Ukraine, when it comes to climate change, my sense is that these crises are really having a type of accelerating effect. We already saw quite a strong movement here in Europe before the crisis, but let me just give you some examples. For example, in relationship to the pandemic, what we've seen is the Next Generation EU Fund, which is part of the recovery program. This is a potentially up to around 800 billion euros. And the idea is that member states should be allocating at least 37% of this recovery to the climate transition. In the context of the war in Ukraine, we have the Repower EU initiative, and we should be getting some more news on this on the 18th of May, so perhaps a date to watch there. And the idea here, again, is with the idea of reducing dependency on energy imports from Russia. Part of the response is also to accelerate investment into renewables and also into energy efficiency. What strikes me also is in the corporate sector, we've seen, of course, with the COPs, we've seen more and more countries signing up to climate targets, but it's not just about the governments, it's also about the corporates, where again, we see more and more targets being announced and being pushed through. And I can say I see this at my own institution as well, where we've signed up to the Net Zero Banking Alliance, but we're far from being alone in having done so. And it's interesting as well that central banks are really also thinking very hard about this. So I've just been through the ECB's climate stress test, which was at the same time a fantastic learning experience, but at times also a bit of a frustrating experience in terms of climate data, and probably something we'll touch upon today. But as we look at all these topics, Timo, I'd like to turn to you first, and perhaps if you could give us an overview of these many drivers and dynamics.
Yes, good afternoon for my behalf as well. As Michala indicated, so it had been quite exotic to think about this kind of title a few years ago, but now we are there. And that's why I've added the subtitle, Case ECB. However, I need to start with my background. Almost 25 years with Bank of Finland, sidestep to OECD, London School of Economics, Bank of Spain. After that, chief economist of one of the commercial Finnish banks, Aktia, almost 20 years. Now, 5 years after retiring from Aktia, 5 years as chief economist of Climate Leadership Coalition. Michala mentioned corporates, companies, and its role. In Finland, and I would say globally, it is now leading the process. One example is CLC, our organization. It started 8 years ago with 7 founding members. Now we are 85 organizational members, companies, cities, universities, even trade unions, think tanks, and believe it or not, even the Agricultural Producers Union is a member of this CLC. And what these share, these members, is that they want to be the winners in the world which is changing on its way to low carbon economy. They want to be in the avant-garde, able to supply solutions, services, products which the future world is hungering. My highlights, to begin with discussion, they come from the report published by ECB last summer. According to the ECB, climate change and the transition towards a more sustainable economy affect, first, the outlook for price stability. Second, the outlook for financial stability. Third, the transmission mechanism of monetary policy, and even in a way which may weaken the strength or efficiency of monetary policy. And finally, the value of the risk profile of the assets held on the Eurosystem's balance sheet, potentially leading to an undesirable accumulation of climate-related financial risks into ECB's balance sheet. So this is a comprehensive statement which covers all aspects of central bank policy. I have to say that unfortunately, or perhaps even surprisingly, the process of this understanding or new stance, it has been rather slow. Okay, the first background, for me, the first milestone, or my analysis starts with financial crisis. It was generated by mispricing of assets due to the opacity of the US housing, subprime housing laws. 2009, Financial Stability Board was established to enhance, or let's say to reduce the risk of replication of financial crisis. 2011, something important came to public knowledge. British think tank Carbon Tracker Initiative published a simple calculation. Step one, how much CO2 there is in the atmosphere. Step two, how much more can be emitted before 2 Celsius degrees is exceeded. That gives the difference is the carbon budget or emission budget that the world can use. Step three, how much CO2 will be emitted if all known reserves will be burned? Conclusion, approximately 70% of known fossil fuel reserves need to be left unburned. The anomaly was that market valued these reserves in their full value, present value. So there appeared to be a carbon bubble in the market pricing. 2015, perhaps reflecting this idea, was that the FSB, Financial Stability Board, led by Mark Carney, governor of Bank of Finland, it invited Michael Bloomberg to lead a task force for climate-related disclosures. It published the first report in December 2016, and a guide for implementation was released in June 2017. And in that summary paper of that report was this sentence: because this transition to a low-carbon economy requires significant, and in some cases, disruptive changes across economic sectors and industries in the near term, financial policymakers are interested in the implication for the global financial system, especially in terms of avoiding several severe financial shocks and sudden losses in asset values. And this was not, so I already indicated that in the ECB's today's statements or present thinking, this is in the heart of climate, of central bank policy. But this is not now, not ECB speaking. This is the highest authority of financial sector, Financial Stability Board. G20 countries, all with their central banks, all important international organizations as its members. When we talk about climate change and ECB, it's all about mandate. ECB was founded in the process, or its mandate was defined in the process where member states had quite diverging views, and it was a kind of political compromise. The primary objective of the ECB is price stability. It is allowed to support other general targets of the Union, European Union, if these actions are not harming the primary target. Now there were, okay, first it was thought that it's about that there is a kind of under certain conditions, ECB can be active on the growth and employment issues. Then came Euro crisis, financial crisis, new fields for ECB to be active, and now the new one newest one is the climate change. However, this time is different compared to the earlier ones. Now, according to ECB, climate change is not an issue related particularly to the secondary target. It very much relates to the primary target as well as the secondary target. So it's a kind of common principle going through all central bank thinking. Last July, ECB wrote, ECB presents action plan to include climate change considerations in its monetary policy strategy. That's it. We come to the specifications back in a while if we have time. However, ECB makes clear that the primary response for climate change policy is within the European Union, and ECB acts just in a way of supportive manner, and it also calls itself that it wants to be a catalyst vis-à-vis the financial sector. And this is where, when we talk about this price stability, the primary target, this is where the ECB, in my view, makes an very elegant work. It's presented in ECB occasional paper 271, titled Climate Change and Monetary Policy in the Euro Area. It is a carefully written, reference-based, detailed analysis of the channels through which climate change influences inflation, productivity, output, and employment. And what is important and interesting, this is the first time to me that in this kind of broad analysis, there's a special view on what we call transition period. So often we take that, hey, now we are here and our target is there. But about the path, what happens between these 2 points? This is something that I find very highly useful in the analysis of the ECB. It also, we have in the morning, we talk about natural interest rate, R star. ECB states that this climate change may and tend to influence the level of R star. It influences transmission mechanism of monetary policy. It may weaken the efficiency of monetary policy, particularly during the transition period. And I think that when I say that this is research-based, I would say that this is only a beginning of, I think, what I'm expecting to see, a severe, ambitious research on this issue. And this is a kind of survival strategy of ECB, because it must convince all the public, all media, politicians that this is a correct choice to take this role into its policy. ECB has published 3 scenarios. One is with an called orderly transition. One is delayed transition to carbon neutrality, and one is a sudden transition scenario. In all respects, the least costly is the orderly transition scenario. Delayed transition is considerably more costly in terms of lost output, higher inflation, etc. But the worst is that you wait for, and then you are frightened for how bad the consequences of climate change are appearing in the eyes of public and citizens, and then you made a kind of panic reaction, sudden tightening, and that will create create most turmoil. What's interesting here, ECB also analyzes the effect on equity market, and on aggregate level, they conclude that in the case of this orderly transition, the general impact on equity market could be quite modest. But the risk is that, particularly in the other scenarios, there may be shocks. There may be in certain sectors, and that's clear to me that it's going to be. There will be a lot of stranded assets, and that may create a kind of turmoil with dramatic implications. ECB has established Climate Change Center. Today, according to my understanding, it now has a dozen specialists, including economists, climate scientists, lawyers, data people, and I wouldn't be surprised that if that will be growing. And it's not a kind of one more silo, but it's a kind of vertical element over which enhances the cooperation between all existing silos or lines. There are 6 activities specified for this climate center, which they should enhance. One is about macroeconomic modeling as an assessment of monetary policy transmission. And there, in a way, I was pleased to notice that it appears to me that ECB is not dreaming of a huge, all-covering model which would explain everything. I think that would be a hopeless task, and more recent literature have supported this view. But rather, you need to have many specific climate-based models, economy-based models, and then you link them and test the outcomes from different angles. Okay, data, more indicators, that's clear. Then there are 4 more areas. One of those is here, and the rest of 4 are there. And in a way, in my view, these all are related to the same idea. And one example is that ECB argues that there is a danger that if the ECB cannot be sure about collateral given for financial operations, central bank financing operations, it may be that climate risk will, in a way, hidden way, enter the balance sheet of ECB. And all these different kind of ideas, what you need to, what they stress, that's something that will be very demanding for banks. Banks who want to do these financial operations with the central bank, they need to improve their study of climate risks dramatically. And if it concerns banks, it of course concerns the clients of banks. And this is one more way where you push the idea which started from the TCFD. It was a voluntary recommendation that all this information must be or should be given to all financial actors in order to avoid a new pricing bubble, creating a new financial crisis. IFRS, the one dominating reporting, they are now pushing the same process that they make this TCFD type of recommendations, that they become mandatory in all more than 140 countries which are following the IFRS standards. And now the ECB is here on within the Europe, on the European continent, working on the same issue. And I have to say that I'm very pleased to still live to see this. And I'm quite convinced that the other major central banks will follow. Thank you very much.
Thank you very much, Timo. And indeed, we get a sense of the complexity of the issues that we're facing here. And just thinking about the economic impacts, and we think about the climate transition, of course, I focus perhaps today a bit more on the transition than on the physical risks. I think the physical risks are something that we intuitively, I wouldn't say we understand them well, because I think they're very uncertain, but we have perhaps a better vision of what they are: flood risks, drought risks. We can understand the long-term risks to the ecosystems and the damage that these cause. But when we think about the transition risks, this is something that's becoming quite new, and many of the transition risks are also policy-driven. And to my mind, we can really see this balancing act we want to have. In the beginning, perhaps, the transition was relatively simple because it was about getting more data and more understanding. But now we're getting to a point where we also want to push more on the levers. Now, as economists, we often think about the main tool of climate as being a price, the carbon price. You know, we have this idea that all you need to do is get the price signal right, and then everything else falls into place automatically. But we know it's much more complex than that. We know it's about making sure that we can have a smooth sector transition, because when we think about the climate transition, it's about the sectors. It's about moving from high-emitting sectors to low-emitting sectors, so we need to move our labor forces around. It's also about changing our capital structure. some of the capital structure will become much, much more quickly obsolete. And you referenced some of these risks with the stranded assets. And then we also see this need to accelerate the investment. So there's so many moving parts in this climate transition. And Nathalie, what really strikes me is not so much whether central banks are legitimate in looking at climate change. I think it's quite clear when it impacts growth, inflation, and assets, central banks should look at it. But my big question is, how should the central banks think about playing their role as a catalyst here? How can they think about taking an active part in this policy mix? And you know, I was struck this morning listening to the governor on monetary policy about let's go careful, optionality, thinking about it. And this is monetary policy, which, you know, is very complex, but we know it a little bit. And now we're on climate change. How can we dose something like this? How can we think about it? How do we get the right levers there? I think your job is very tough.
Indeed. Thank you very much, Michala, and good afternoon, everyone. I hope you're right when you said at the beginning that those crises are accelerating the transition toward a decarbonized economy. It's not always the feeling, at least in the short term, but we really need to keep in mind that there is urgency. And I think the recent IPCC report really reminds us of the urgency of the situation. So although all the geopolitical situation and all the economic background is very complicated, I think we need to keep it in our radar screen, so first of all. Maybe also on what you said, two preliminary remarks. First, as you mentioned, governments and parliaments are responsible for climate policy. And these policies are, of course, of critical importance. You mentioned carbon prices or carbon tax. Of course, from an economist point of view, it would be the best way to accelerate and to organize the transition in an efficient way. It's a very sensitive issue, very political issue, so we don't really have it. Or maybe we start to have it, but not completely and not globally. So does it mean that we can't do anything? We don't think so. Really, the climate policy is a component, but we think it's not a prerequisite. And as very well explained by Tony, we really think that central banks can do something, can play their role here, and that each actor, not only central banks, can and should take the climate challenge into account. So, role of central banks, as I said, we can't do everything. We have to stick to our mandate, and it was very well explained. Not all central banks have the same mandate, but in general, they all have price stability, financial stability mandate. And it's why we said it's climate change concern is really at the heart of our mandate, because it has an impact on prices, it has an impact on growth, on output, on productivity. So it is really in the heart of our mandate. And of course, climate change is a source of financial risks. And so on the long term, a risk for financial stability. So it is also a concern from that point of view. So what shall we do? What can we do? Maybe not all what you said, Michala, but I just have one slide, and my idea is that we should do all what we can do, and to integrate climate change in all our work, and at least in 4 dimensions, the 4 ones, the 4 that are on the slide. And I will start with supervision. Tony was really focusing on monetary policy and greening the monetary policy, but we have other dimensions. The first one on which we worked is financial stability and supervision. Of course, because the financial sector is particularly sensitive to climate-related risks and due to its key role in the economy. So here we started really the work here on that aspect, and I think we made good progress in identifying the risk and classifying it between physical risks, transition risks, better also assessing these risks and trying to build up tools in order to mitigate those risks, in particular with a climate stress testing. For example, the ACPI, the French supervisory authority, has launched a stress test exercise in 2021 with all the major players of the French financial sector, banks and insurance. We published the result in 2021. And as for the current ECB climate change stress test, we saw the many difficulties we can meet in terms of data, in terms of methodologies, in terms of how to make appropriate forward-looking projections and so on. But we think it's really a concrete tool that the community of central banks is providing to the whole financial sector in order to better assess these risks. So that's the first dimension. A second dimension, which is important also, is our role as a responsible investor. Actually, many central banks and most of central banks manage large portfolios. And there are at least 3 reasons why we should include climate change in our portfolio management. First, we have to walk the talk and to apply to ourselves what we preach. Second, we also need learning by doing. I mean, it's a very technical and complicated topic. When we started a few years ago, we really had to train ourselves, to train our colleagues, to increase expertise, and it's a long journey. And third, of course, as mentioned for the ECB balance sheet, it's a way to reduce risk related to climate change in our balance sheet. So the Banque de France, for example, has a very ambitious strategy for as responsible investor for its own funds and its pension funds. And we are currently working on aligning our portfolio, those portfolios on the 1.5 degree. Monetary policy, the third dimension, very important. It was well presented by Tony. I think really this aspect of modeling and trying to see how we could incorporate climate change in our forecasting and our understanding of the macroeconomics is now key, and the crisis has shown that. And in particular, the energy crisis shows that we really need to have maybe a long-term view and to include these aspects in our modeling. It's a very complicated work, not easy, but at least we try to do it. And the fourth dimension is supporting green finance, because actually, due to the huge investments that will be needed to realize the transition, to implement the transition, we really need a mature, sound, and efficient green finance. And here the key question is about the risk of greenwashing. So we need transparency, we need disclosure in order to avoid this greenwashing and the risk of loss of confidence by investors. And here, of course, the green finance is moving up very quickly, but we have not completely settled this issue. That's why many regulators are working now on this issue of disclosure. It's a big debate. On the European level, we have a very big regulation which is being finalized with many aspects. You have also at the international level the ISSB, who is working on the framework. So as a supervisor, central bank, our wish is that those framework converge as much as possible and that they are getting applied as quickly as possible, because we know that time pressure is very strong. We need to act quickly, and we can't wait until all data are completely fine with all details. So we really need to converge to have the most efficient framework as possible, but also not too lengthy discussions. And I would like to add a last consideration is how to do that, because it's a very complex work. And here I would like to mention the key role played by the NGFS, so the network for greening the financial sector that we founded in 2017. Why I say that? Because you see it's very complicated, and we really need, and we are starting from zero. So we really need to have a collective approach, to use all our resources collectively in order to be able to provide solutions, analytical tools, operational tools. And we started with the NGFS in 2017, we were 8. And now it's more than the Tony's committee, because we are something like 114. It shows that central banks and supervisors are really convinced of the importance of this task and that it is within their mandate. And I think it was key in success in really making a huge progress over the last 4 years, and in particular in supplying our community with guides, analyses, tools, and they already start to implement them, as shown with the stress test on climate scenarios. I stop there.
Thank you very much, Nathalie. And I think, I don't know if I'm allowed to advertise the NGFS, but I will anyway. If you're interested, there's a fantastic amount of working papers on the website, and also increasingly tools in terms of scenarios, things to study and look at. So if you're interested, I really would recommend it. And I thought it was very interesting you picked up on working paper 200, or occasional paper 271. I can see a few of my team members up here, and I think they know it by heart by now. So it's perhaps the best paper I've seen in terms of setting out all of the economic channels of climate change. I think it's a very good paper out there. But of course, we need to get from all of these good ideas to a reality on the ground. And the other issue we're confronted with is our atmosphere is global. It's not a European atmosphere, it's a global atmosphere. And Thomas, sitting from your side, I'm wondering, how do you think about climate change on the ground in terms of financing, in terms of globally? How do we get the right financing flows to where they should be, and how do we optimize this?
Thank you so much, Michala. First, I'd like to say thank you to the organizers. Usually you say it because you're polite, but here it's very true. I like the conversation between central banks and public development banks. I think it's a very important coalition to build. You asked me to talk about the situation in developing countries, so I will do it. And first, what do we need to have more and better climate finance in developing countries? First, I'd like to say we probably need better plans. We have terribly bad plans in developing countries. We all, as investors, want to be 100% aligned with the Paris Agreement, but what exactly does that mean? Nathalie just said that in Europe, the taxonomy is built to be compatible with a 1.5 degree global warming, but that's not the case in most countries. If you look at the Paris Agreement, so you have this objective of limiting climate change to 1.5 to 2 degrees, but the total of NDCs, the nationally determined contribution, rather leads to 3.5 degrees or something like that. So it's not, if you want to be aligned with the NDCs, it's not the same as being aligned with the Paris Agreement. Immediately after the Paris Agreement, most countries began to work on their long-term strategies, which are more ambitious, but not necessarily always compatible with the NDCs. Typically, NDCs in developing countries lead to a relatively high point emission peak, and then a very steep decline, but by pure magic. So you have to be more consistent, not only act quickly, but also revise plans so that peaks are lower and lead us to imagine a more credible long-term strategy. We're trying to, by the way, at AFD, to support developing countries in writing and explaining their long-term strategies, not only so that they are credible in terms of carbon emissions, but also socially feasible. It has been said that carbon price, for example, is a very sensitive issue. It doesn't mean we cannot finance or build up transition. It means we have to precisely look at the social conditions related to energy or agricultural transition, for example. Otherwise, there will be no transition at all. So we are trying to not only push the concept of just transition, but also to work with the governments in particular, because they have the lead responsibility in trying to analyze exactly how countries are able to design their transition. Just recently, we worked with the government of Vietnam, for example, not only to model the impact of climate change, but also at a more disaggregate level, to see the impact on the hydro energy, agriculture, situation in the delta of the Mekong, for example, to know a bit more precisely where the consequences of climate change will be and how the government can adapt over the long term to this potential impact. So first, we need better plans. Secondly, we also need more powerful tools, and that's where central banks are more active or more directly concerned. Just to give you a few examples, I think Nathalie just referred to it. There is a taxonomy now in Europe with a certain level of detail, but it's not necessarily the case in the rest of the world. So building up norms is a very important step in not only helping to develop green finance, but in general, helping to design trajectories and bringing incentives or guidelines for the financial sectors. Just to
That's very well known in the rest of the world. Could you just maybe give us a little bit of a definition so we can understand this?
Okay, so the way I understand it, at least in Europe, is that you have a list of activities which are considered sustainable, not only by the financial community, but it has been approved of in the European Parliament, for example. So now you have a list of activities eligible typically for green finance. But it's not necessarily the case in other countries. We have tried at AFD to build up norms, not necessarily based on the European taxonomy, but at least to integrate green principles. For example, in Indonesia, with the regulator, OJK, and also the local development bank, PTSMI. We have similar examples in South Africa, where we help DBAC, the National Development Bank of Southern Africa, to emit its first green bonds, but have similar example in Egypt, and also beforehand, even in China, for the writing and the adoption of the green credit principle in 2012. So one way we can help boost green finance is not only to develop the norms in Europe, but to help build norms elsewhere. We also have to recognize that these norms are incomplete. It's true in Europe, we have a green taxonomy, but we don't necessarily list the activities that are unsustainable. You could say it's the contrary of the green list, but actually it's not true, because you have a number of activities that are neutral, and therefore you could emit bonds without causing any particular harm while financing activities. But there are also toxic assets or stranded assets, which should probably lead to the adoption of disincentives. A green taxonomy gives us an incentive to invest in green assets, but we don't have, on the negative side, the disincentive. And that, of course, that would be very useful to improve risk management amongst financial institutions. When you screen a balance sheet, you need to know which asset will be protected or will benefit from a financial incentive, but you need to also to identify the more risky asset. Actually, we've done a research exercise with the Banque de France, a paper called the Silent Spring, to screen assets amongst French banks and identify which assets might be exposed to climate change or environmental change. I think that's very useful. It's a research paper. It's, I think, very important, but to some extent, it's the preliminary to a more extensive form of taxonomy or set of incentives so that we can be more efficient in the fight against climate change. Also, because my neighbor has an interest in central banking theory, we have not discussed that much to what extent asset purchases by central banks should be neutral or not neutral. Personally, I don't like neutrality. It's a very, it seems like a passive concept rather than more active policy. And I would plead for more forward-looking purchase policy, meaning central banks buying assets of private actors, not from the market as it is now, but probably as it should be. But of course, the final part of the job, or maybe it's the first part, I don't know, but is how financial actors will have to manage stranded assets. Is it by themselves, or will there be some sort of new actors like bad banks or other mechanism so that stranded assets can be removed from balance sheets of most actors? And at which cost? It's a very difficult topic. Someone will have to pay for the winding down of financial risk within actual financial actors. So it can be shareholders of the current shareholders of banks, but there are other schemes, typically, which could, by the way, involve central banks if that's typically a specific target for asset purchasing. But it's a complex topic, but someone will have to pay for the winding down of risk if we want to act swiftly. And I'm not sure fiscal policy in the short term will be able to do that, considering that we are just coming out of first a financial crisis, now a COVID crisis. So that's probably a lot to carry by governments. And last but not least, if you look at the north and south divide, I'm using the term divide because I've been struck at the last COP26 in Glasgow by the tone of the conversation, which turned a bit sour on climate justice. One reason for that is that, as you know, the 100 billion of climate finance, which had been promised in Copenhagen and then again in Paris, had not been reached in 2020 as expected in the first place. So there's a little bit of delay. I think it's going to be reached in 2023. So it's not a catastrophe, but still it turned the conversation in the wrong side. But apart from that, we know that climate change in general is not a 100 billion topic. It's a bigger topic than that. And it doesn't necessarily mean that it's just Europe or the US who will have to pay for the loss and damage caused by climate change. If you look at the list of carbon emissions in the world, it's not only the US and Europe. It's also China, it's also India, it's also other countries. So tomorrow, the debate on climate change and who's responsible for loss and damage, if it's sort of an insurance mechanism that has to be built, I don't think it will be built on the same categories as official development assistance in the past. It's a different process. It's emitters and the countries that are most likely to be hit by climate change or seriously hit are not necessarily always the poorest. Typically, small island states are more vulnerable to climate change than other countries. So it's a different vision of the world that will have to be established or negotiated if we're considering climate justice. But I'm sure the climate justice discussion is very uncomfortable in Europe or in the US, probably in China as well. But it's not because it's uncomfortable that it's not going to happen. So I would plead for preparing for the topic, even though it's not on our hands right now. Thank you.
So thank you very much. We have a few minutes for questions, and I must admit I have quite a long list that I would love to ask. I probably won't get through all of them, and I want to give others a chance as well. But I think I'm tempted to turn to you first, Nathalie, on this one, because from where I sit, it's of course a little bit exciting this year because the ECB, and I appreciate you may not be able to say so much about this today, but maybe just to share with the audience, the ECB has told us that this year they will be telling us perhaps a little bit more about how they're going to include climate on the collateral policy. And given the key role that collateral plays in the financial systems, and in particular through repo operations, it's, you know, we can, the same way we think about a deposit multiplier, we can think about a collateral multiplier as well. And it strikes me today, so, you know, my first question to you is anything you can give us in guidance of when we can expect some news, I think is always very exciting. But it strikes me today that, you know, we have this very nice, smooth, orderly transition chart. But it strikes me today that as we are in an uncertain and unknown world, we're caught between a little bit of a difficult situation. At the same time, we know we need to move quickly. We know we need to accelerate. But the acceleration itself can bring risks and risks to financial stability. And I think you alluded to some of these problems as well. So I wonder if you could say a few words about how do you manage this desire to move more quickly and at the same time the desire to preserve the financial stability?
Two good questions. On the monetary policy greening and the ECB, so it was decided last July to launch a very ambitious roadmap, and experts are working on it now. And of course, the all is very complex. We are still waiting for the outcome of their work. Normally, the Governing Council should look at it in the middle of the year by summer. I would like to play down a little bit what we could do in terms of collateral. Because actually, you know that we are very... we set the level for eligibility of collateral at a very high level. We want to have very safe collateral, so a very large part of it is of sovereign bonds. And the part which is where we can really apply climate criteria is collateral based on corporate collateral, corporate securities or corporate claims. And they are a smaller part. So just to, but I think the signal is very important. And really what we want to do, but it takes some time, is to screen all the issuers, corporate issuers, according to methodologies that we are trying to develop internally, and which will take into account all the available data. So there is a link with the disclosure regulation that we are waiting for, also for this reason. But we would like also to take into consideration the transition, because in our view, it's not really the best way to base our collateral, the greening of our collateral policy on a point-in-time considerations, but we really want to see the transition. So we need to collect information on the transition plans of these issuers. So that's the spirit. And we are working on that, but you see that it will take time to be really completely implemented. But that's the spirit behind. As regard the purchasing program, because you mentioned it, I think that already those purchasing programs have an important footprint in the market. So the market neutrality is very important in order to avoid adding another footprint to the original footprint, which is the size of our purchasings. So we try to avoid change of allocations among sectors. Here we have said that we are going to work on possible tilting of the corporate asset purchasing program. So we're also working on that to see how we can implement it. And I think the signal will be strong, but of course we can't completely change everything, and we need also to keep efficiency in our monetary policy implementation, because it is large volumes, and it is still in our mandate to keep inflation to our objective. we can't forget that, and we have to make it compatible. And now, regarding your second question and the short-term risks, it's true that our first stress test scenario was based on a long-term vision, long-term horizon. It was something like 30 years, up to 2050. And actually, we saw that at the level of the French financial sector, the overall effect of the climate stress was not big. It was quite moderate. And we saw that the main impact was maybe on the physical risk side, especially for insurers and in some areas in France. And looking at what was happening, we thought that we need to look at shorter-term shocks, including climate change shocks. And we are working on a new release of our NGFS climate scenarios, and we want to include shorter-term scenarios with shocks, climate shocks, and also to measure their impact on balance sheets and financial risks, but also to have a broader view on the financial stability. But it's a very complex exercise.
I can only agree with that. I will look forward to the new stress test and the short-term version in that case. So, but thank you very much for this. And maybe just if anyone has a question, I can see there's a question up there. So I'm just conscious of time. I think.
Oh, thank you. Thank you so much. A question for Nathalie. The Federal Reserve had reviewed its strategic review that ended back in the summer of last year. And the focus appeared to be much more on the concept of inclusion as opposed to climate change. Do you think that this might slow down the narrative and the efforts from other central banks, particularly in Europe, the ECB, the Bank of England, to move ahead in their efforts of tackling climate change? Thank you.
First, this inclusion focus in the case of the Fed is, I think, very much related to its dual mandate somehow. And of course, it could be considered as part of the larger considerations related to ESG. In my view, and what we have seen in the NGFS work, we remain very focused on climate, and I don't see it really changing the way central banks are working. I would mention that the Fed is a member of the NGFS and work also on the climate aspect. So I don't. Of course, it's important for us that the Fed is also on board on this topic. You know that in the US, there is a strong political background that can also explain the situation. And I would say that maybe one new aspect which is more emerging at the level of the NGFS and maybe other coalitions and also in governments is more the nature-related risks and the level of and the issue of biodiversity loss And actually, at the level of the NGFS, we have recently released a statement considering that the nature-related risks are also a source of financial risks, and we are starting the work with a dedicated task force to see how we can develop a framework to work on this. It's even more complicated than climate change because we don't have a single metrics like carbon price, but it's also something very important. So I see more the direction of the work in that field.
I think there's a question up here, please.
What we saw in the intervention is a very strong difference between the Finnish view and the French perspective, especially on the method way. In order to establish the guidelines to improve our capability to react on climate change, it must be different methods available. But what I would be interested is to know on the French perspective, which one would be the most appropriate. Impact studies, one is the impact studies evaluating in the middle and long term what are the distribution of assets which might improve the creation of common goods and wealth. And according to the result of these impact studies, for example, having a differentiated taxation policy, which should be implemented including in import goods, or if you don't want to go that far, which way would be available or equitable in France to deal with this matter without disturbing the actual lobbies which are negotiating their share in the value chains, because if you interfere in any way with any of this proposal, you will disturb the existing equilibria of resource allocation within the value chain of each activity. Which way do you think the central banks might have the ability to interfere with that, and how far?
So Timo, would you like to jump in on this, especially
Yes,
with your good perspective of Europe as a whole?
Yeah. For the first, I think it has been a long time understood the fact that allowing climate change to proceed, business as usual, it will be much more costly for the welfare of global welfare than to mitigate the process. And on the other, and the next point is that I already referred to that. Okay, just a memory from the Glasgow COP conference in November. There was a kind of innovation hub, and their American guru or something like that. He said that I think we are going to remember COP25, I guess, from that we were laughing at inability of politicians to make important decisions, and we are praising companies and citizen movements for taking care that the program will be, that the mitigation project will be carried on. And the financial sector has been a very important player there. I already indicated that TCFD report six years ago or so, and it related exactly to the pricing risk and stability of financial market. And therefore, in a way, for me, the question furthermore, the solution, there are such an amount of technological progress going on in different fields that clean products, they will become very quickly considerably cheaper than the dirty ones are today. especially food. It will be much cheaper, more healthy than the food, present food production. All this hydro energy, which gives new possibilities for vehicles, etc., etc. So there is so much in the pipeline that the question that for me it's difficult to think that one could. I was about to say that one could lose, but clearly there are groups and locations which are losing a lot. Coal mining districts, people who lose their jobs because of disruptive changes. But in a total economic, global economic view, national economic view, the welfare created by the national economy in 10 after the turmoil, after the transition period is over, for me, I believe that the living standards are much higher than they are today. And now you need to consider as a living standard also better health.
And I think we also have to consider here that our time is almost up, but I'm just tempted to bring you in, Thomas, on a final quick point here. And you mentioned something which I think is really important, Timo, which is about the technology and the technological progress that we need to see here. But it strikes me when we talk about finance that there's a little bit of a question perhaps between debt and equity, and especially here in Europe where we know, so this is a loaded question because I cannot go to a conference without saying that we need to finalize the banking union and create the capital markets union. But how important do you think it is that we have this equity dimension more present perhaps in financing the climate transition?
So if I take the point of developing countries, first I'd like to say that developing countries are not going to be developed by capital coming from the north. It might seem paradoxical because I'm working in a development bank, but we are highly convinced that we need to help most developing countries develop their financial sectors, collect their savings so as to be able to invest, and the capital coming from northern countries will be an accelerator, but not most of the capital invested in developing countries. So just to minimize my role, but I wanted to make the point. And secondly, it's true that equity for typically renewable energy or energy transition in general is relatively scarce in developing countries. There are lots of savings actually, but not necessarily a similar level of investment apart from a few countries in Asia. So we end up with a level of investment that's too low, not only to accelerate growth, but also to finance a transition. And actually, we are not in a very good position, whether in the US or in Europe, to bring equity towards developing countries because it's very expensive. Typically at AFD, for example, €1 of equity invested in a developing country costs €1 of capital in our balance sheet. So we cannot leverage on equity for regulatory reasons. And I'm not saying it's bad. I'm just saying that's the situation, and it's not very likely to change. So it means equity will have to come mostly from developing countries themselves, and the capacity to collect savings and to use it as equity in investment. We can provide debt, for example, more easily. Typically, we leverage almost 1 to 10. So based on our equity, we can do up to 10 euros of loans, but it's not the same for equity, which is why we'll have to invest in not only people, but also institutions able to collect money and invest in equity in developing countries, because certainly that's part of the main gaps. We have to recognize as well that there are not enough projects to be invested in. If you look at Africa, for example, the potential for renewable energy is huge. You have abundant land with few contradictions in objectives. The price of electricity for customers is high, but the price of production now with renewables is low. So you might wonder why doesn't capital flow from rich to poor countries? It's the name of a famous paper in the late 80s. But the truth is that it still doesn't, and it's mostly if you look at the Robert Lucas paper at the time, the various criterion that he listed are still more or less the same: information asymmetry, risk, difficulty in access to land, government capacity capacity. And this is where basically development banks can play a role, including from developed countries, because they can provide a higher level of guarantee, whether for non-repayment, but also access to land, non-predatory behavior of governments. And so we can leverage not on our balance sheet, but on other technical or institutional capacity. Thank you.
Thank you so much.
I need to add something to my former answer. When I talked about these groups which are losing all locations, we need to take care of them, because if we don't, we never get the support of people of this mitigation policy. That's a prima facie fact. But in the long time, if we take a bit longer period, I'm certain that if you think about Southeast Asia, etc., Africa, those groups who suffer, they are much more millions or tens of millions than we talk about, let's say, within Europe.
So I think this is, a very important point to conclude on, the idea of the just transition, which is clearly also one of the key policies in Europe. And with that, I'd like to ask everyone to join me in thanking the panel today. Thank you, everyone.